Okay. All right. So everybody, this is the new semester for the new session of the International Macro History Online seminar series. The presenter today is Lukas Diebold, and he will be talking about the interwar capital flows, hot money in the interwar. I should say a few words to introduce Lukas. Lukas got his PhD in Mannheim, and he has, I think, just moved. He's an assistant professor at Carlos Tercero in Madrid. I'm Marc Flandreau. I'm a War Marx professor of economic history at Penn, and I will be moderating this session. Lukas, I guess it's for you to start.
All right, then let me share my screen again. I hope you can all see that. And yeah, if you cannot see that, hello from my side also to everybody. Thanks to Mark for the introduction, to Rui for the invite. And yeah, I just moved into this office, and it's my second day in this office. So in advance, apologies if anything should not work out as it should. It's not a tried and tested equipment yet. So what I'm going to be talking about is basically all in the title that you can see on your screen. It's golden fetters, it's a credit boom, it's capital flows, and it's the interwar. And this is sort of the very much extended version of my job market paper. There's a couple of editions which I have not presented so far in the job market based on all the feedback I got there. And I'm looking forward to your feedback on this. So what I will be talking about is basically capital flows in the interwar period. And there's, of course, a super long history of trying to explain domestic economic conditions, domestic financial crisis with international finance and especially capital flows. And this approach sort of ebbed and went with fashion. And before 2008, there was not that much interest in it. But after 2008, there was a lot of new research. Research was invigorated because we had all seen these huge amounts of capital movements before 2000, before the 2008 financial crisis. But traditionally, there has been a focus on net capital flows, the workhouse being the current account balance. But empirically, these are relatively unreliable in predicting economic outcomes and financial crisis. So the post-2008 financial literature more emphasizes gross capital flows. So they outweigh net flows in size. And the main idea is that if there's a global financial crisis striking many countries at the same point, some of them might have a deficit before, some of them might have a surplus in terms of the balance, but they could all be hugely exposed to capital movements via gross flows. But empirically, there's relatively little evidence. And so I think, the first one to systematically exploit a new data set on gross capital flows in the interwar period and link these gross capital flows to the Great Depression and more generally the interwar business cycle. So what I do is I collect this data, which is from the League of Nations data. I say a little bit more later on. It's a relatively large sample of 33 countries between 1922 and 1938. And in the first step, I will show you a couple of graphs just to see how these capital flows looked like, how they moved, if they were cyclical around the Great Depression and so on. And then more systematically try to disentangle how they were related to the business cycle and financial fragility. So I will be using relatively standard tools like local projections, probability models for crisis prediction. I will hopefully convince you that I have a nice IV for these capital flows, and I will show that the channels relating these two, the capital flows and the economic outcomes, are better for gross compared to or better link gross and economic outcomes than net flows and economic outcomes. All right, what do I find? Well, I find that gross capital flows are really cyclical. So they peak in 1929. They show this almost iconic boom-bust pattern around the Great Depression. And I will also show you that net and gold flows, which have, as I said previously, been the workhorse for this kind of analysis, show no comparable boom-bust dynamics. I also find that large gross inflows, so foreign borrowing, are related to reduced future GDP growth and increased likelihood of financial crisis. And I don't find this for gross outflows, so capital exports and the balance of capital flows, which are the net capital. I also find that countries that were very highly exposed to capital imports and foreign borrowing before financial crisis tended to have deeper recessions in the aftermath of the financial crisis. And I will talk a little bit about fixed exchange rates, mainly the gold standard, and foreign debt service in trying to link these two variables. And then in the IV section, I will exploit variation in US foreign investments abroad, which are bilateral, so US to other countries, in a type of shift share instrument to tease out exogenous variation in capital. And I will talk about all of these channels later on, but just to give you like a very, very quick overview, foreign capital is often unrelated to domestic economic conditions, which is sort of this global financial cycle instrument or argument from Hill and Ray. Capital flows are likely to dry up and disappear during crisis. You have the possibility of funding domestic balance sheet growth, which creates maturity mismatches if you lend long and borrow short in international markets. So those are all sort of related to the dynamic of capital flows around crisis events, which might increase financial fragility. And then there's also the idea that if you borrow abroad, your interest payments in the future will also flow to foreigners, which amounts to a wealth transfer abroad in the long run, which might also contribute to lower future growth. Then finally, the gold standard had a dual function. On the one hand, integrating countries into the global financial system, so creating exposure to these kind of dynamics, but on the other hand, restricting the scope of action to respond to them because it limited monetary policy mainly. And empirically, I will show you that net flows, whenever I go through these channels in the course of the presentation, only partially are able to capture these arguments. So where will I contribute? I will be very quick here. So the data is a huge part of the contribution. It's been known to previous authors, but it has not been systematically exploited yet. Previous authors have argued that there are severe limitations regarding the data, and I think that's to some extent true. I don't think they have sort of overemphasized or overestimated what the limitations are, but maybe a little bit underestimated what we can learn from the data despite these limitations. And so I'm the first one to construct like a full data set which can be exploited using modern econometric methods. Then I want to, of course, contribute to the literature on capital flows and macro financial outcomes. I think this is almost self-explanatory. I want to add the idea that we can link these two variables around the Great Depression. And then for the Great Depression itself, I want to contribute to this sort of international dimension, which has previously focused on the gold standard or the common boom in domestic credit, by arguing that the Great Depression could also be told as a story about an international credit boom going bust. So what is the data I'm using? Well, it's this one. It's the memorandum on the balance of payments from the League of Nations. It's I think the first attempt at homogeneous accounting across countries for this kind of data. And the data, which I will show you on the next slide, and a snapshot from the data, contains net capital flows, gross inflows, and outflows. And it's important to say that this definition is a little bit different from how we would define capital flows today, as these flows include every financial transaction which goes across the border, meaning it doesn't distinguish between you exporting capital because you invest abroad or because a foreigner is pulling away his money in terms of capital flight, for example, in a crisis. So it's an approximation for what we would consider capital exports and imports today. But I think it's still quite interesting. I'll show you on the next slide. And I combine this with with other databases for GDP, for financial crisis from other authors, to be able to link these capital flows to the business cycle. this is what it looks like. This is a summary table from the League of Nations. And what I will be focusing on is essentially these three numbers down there. So you see that there's the capital account and the current account, and the balances of these two should, at least in theory, be perfectly equal, one being the inverse of the other. Because they are not, there must be some misreporting or statistical inaccuracies with it. But generally speaking, they correspond, at least in so far as one is usually positive and the other one is negative. And an important point here is that these numbers tend to be way smaller than the gross flows that they represent. So this is what it would look like for different countries. And here there's the export of capital plotted below zero and the import of capital plotted above zero. And in black, you see the capital account balance for all of these countries. So it would be in the US, for the most part of the 1920s, a capital exporting country, the same for the UK, and the opposite for Germany, being a capital importing country for most of the 1920s. Which is sort of what we would generally find in the literature. These two countries, or with the addition of France, providing capital to the world financial system, and Germany being the largest debtor. But what we can also see is that this black line tells not the entire story, as sort of a relatively stable capital account balance might mask the build-up of gross inflows and outflows over time, which are by construction basically larger than this balance. And this is sort of where we'll be going back and forth, trying to compare the predictive power of gross capital flows to the predictive power of net capital. This is what this would look like across the entire sample, and it partially addresses potential concerns about the data, because this figure sums all gross capital flows over all countries and plots them against each other. And you see that for the capital account, and even more so for the current account, the gross inflow and outflow of capital for all countries is roughly equal, meaning that my sample is an almost closed system of financial accounting, because every dollar that leaves one country by definition has to enter somewhere else. And I take this sort of as a confirmation of the quality of the data, because if this line would hugely deviate, this would mean that one country is consistently reporting figures that other countries are not reporting on their respective balance of payments. All right, so you can also see that there's a huge boom in the volume of capital flows until 1928, which is where Archiminotti and Eichengreen time the sudden stop. But it's clear that it peaks at least around the beginning of the Great Depression and then slumps. All right, now in the next step, I will try to link these variables to the business cycle and run a very sort of standard local projection model where I have cumulative log GDP growth on the left-hand side, credit and debit on the right-hand side, and include two legs of each of the variables. I can only ever run two of my capital flow variables in the same regression, because the third one is always a linear combination of the other two. And what you can see is that the balance on the right, on the left, I'm sorry, has a measurable relationship to lowered future GDP. Meaning that if a country has more net capital imports, it will have lower growth in the future. But if we break this relationship down into the two components of the balance, the credit and the debit account, it becomes clear that the negative response to net capital inflows is exclusively driven by gross capital inflows. And you will see on the next slide in a table that this holds true when we run these two in the same regression, omitting the third one for debit. And this is an incredibly robust relationship. So this is one of the baseline results of the paper. I try to run this with a host of control variables, basically anything I can get my hands on for this period, and you see that it's almost unchanged, irrespective of the inclusion of domestic credit, a gold standard indicator variable, gold flows, or a dummy for financial crisis. So I believe that that's a question. Sorry. And this is sort of one of the key results, but it doesn't yet tell the full story because these positions, as I said a few minutes ago, might pile up over time. So you might have repeated gross foreign borrowing piling up into a large foreign debt position over time, which is why in the next step I sum these inflows over a period of 3 years, so from 0 to -2, and run it in a tabular form where I can more sort of clearer exclude and include the different combinations of the three variables. And what you see here is, again, that a cumulative net capital inflows over 3 years has a measurable, statistically significant relationship with future GDP growth. But the moment I include in the second line gross capital inflows, the predictive power shifts, the coefficient doubles, R-square doubles, and I can reject a t-test for the equality of the two coefficients, meaning sort of the predictive power of capital inflows for future outcomes concentrated in gross inflows. And to control for the fact, if this is just a question of size, so is it a large amount of capital that is being moved that is creating this exposure? I control for gross outflows, which are similar in size. So it's more of an argument which direction of capital flows matters. And you can see that this is unchanged, basically. And this holds for different forecast horizons. And again, this is the result I do the most robustness checks for in my paper. So I try to disentangle if it is driven by different sources of GDP, because the one I have here is compiled across a variety of different sources to get the maximum coverage for my sample. And I use medicine GDP data, economic activity indicators, log growth rates, and it seems to be that across all of these different samples, the relationship is very similar. Then it might be that it's selectively chosen to work for 3-year sums of capital flows. So I try the exercise with 5-year sums. It could be that it's a very small part of the group of countries that's driving the aggregate results via being huge negative outlying values. And in fact, I could quickly show you that and run the same regression on a time series for each individual country. And as you can see, sort of for the vast majority, 3/4, 4/5 sort of the coefficient is negative. I can also test if this is a question of time periods. So I can split my sample in 1929 and look for 1929 and afterwards. I can check it for small or big countries, and I can split my sample by country size. I can split it by having a positive or a negative balance to see if it's state dependent. And again, the results are not that different. Now, a question I've been getting quite a lot recently is how these variables are scaled. And what I usually do is I normalize them because the balance has negative values while the other ones are strictly positive. So to make them very comparable to one another, they are normalized using Z-score normalization. This does not really consider the possibility that for each individual country, there are differences in how large the inflows are, for example, respective to GDP or respective to the country's financial system, so how well it can accommodate. So what I also do, and this is a relatively new addition to the paper, is scale these variables by GDP and by bank balance sheet size and rerun my baseline specification. And you can see that again, sort of the variable for gross foreign inflows, this time scaled by GDP and financial sector size, is the most significant predictor of economic slowdowns. All right. How do these results compare to other variables that have been brought forward in the literature? And the first story is either the Eichengreen-Mitchner story of the Great Depression as a credit boom gone wrong. So I include domestic loans, and you can see, yes, the variable is actually quite similar in size and direction to my gross inflow variable, but it does not diminish the coefficient for this variable in any way. And there might be a story to be told that it might be foreign credit financing domestic borrowing. So the interaction term is included here. And I think this is more of a story for another paper. But there seems to be something here, as all of these terms stay individually significant if they're included at the same time. So as I said, I'm not sort of contesting this, and I think there might be a story here, but it's for another paper. The second possibility, or a second very prominent explanation that has been brought forward, is the golden fetters idea. So not being able to respond to a financial crisis due to the gold standard being very restrictive. And so I include the interaction of a gold standard indicator with a financial crisis indicator. And you can see that sort of individually, both the gold standard and crisis have the expected large negative coefficient. Their interaction is also negative, shy of significance, but most importantly, if I include all of these variables at the same time, the result that I have for my baseline remains largely completely unchanged. All right. Moving on to financial fragility, because the Great Depression sort of sits right in the middle of my sample, and it's impossible to talk about the interwar period without addressing it. There's, of course, a huge literature looking at capital flows, financial flows around crisis, and mostly capital flows tend to be really large before crisis and collapse afterwards. And Archiminotti and Eichengreen have gone so far to call the collapse in international capital flows the mother of all sudden stops. But again, sort of the link between the capital flows, especially net capital flows, and economic outcomes is what I'm interested in, and the evidence for that is not super rich. So what I do first is use a standard profit estimation and just plug in my three baseline variables for capital flows. And the table looks very, very familiar, I guess, just with the dependent variable change to a crisis indicator in the next year. And by definition, almost, the balance has no predictive power here. I say by definition because it's a financial crisis which strikes roughly at the same time for all countries, so 29, 30, 31. And we have seen that the net position across all countries is very, very close to zero. And for net flow, that would mean that it's simply not possible for all countries affected by a crisis to have net capital inflows before the crisis or net capital inflows afterwards. But it's very possible for all of these countries to have huge gross inflows before and huge gross outflows afterwards. But net for all of them would be difficult to reconcile. You can see that again, no matter what I control for or what kind of specification I use, gross foreign credit is the single most robust predictor. And I want to draw your attention to this little statistic down here, the AOC, which is the area under the curve for predictive accuracy. And just including one single variable for gross foreign inflows has almost the same predictive accuracy as including both gross and net inflows, and is way higher than the one for only including net. So the information contained regarding how well the model predicts is concentrated in the gross variable. And then on the right-hand side, I repeat the exercise, but condition the sample such that each country in the sample has to report at least one crisis because the sample includes some colonies, and it might be possible that my result is driven not by countries with large inflows having a crisis, but by countries not really affected by the Great Depression having no inflows before. So I condition on reporting at least one crisis during my sample period and find that the results remain largely unchanged. Again, the same as with GDP, the crisis indicators combine from various sources, and I can understand that this, for people who spend a lot of time with these different chronologies, might be a difficulty because they all kind of measure different things. What I use as my baseline is the Baron-Werner-Hjong crisis chronology, which is supplemented with the Reinhardt and Rogoff, which is supplemented by Grossman. But to test if this is sort of a feature of my dominant crisis chronology, I test the results independently in the Reinhardt Rogoff chronology just to check if sort of it's just a matter of defining it in one chronology or another. In a second step for financial fragility, I try to combine what I've told you so far. So lower GDP growth in the future and predictive power for crisis. So sort of a natural extension for that would be, is the recession that follows the crisis more severe in countries that are previously very exposed to these foreign inflows? And what I do is I basically say, well, a country is comparatively more exposed to foreign inflows if it has above median gross inflows just 2 years in a row. So credit above median in T-1 and in T-2 would, in my case, identify this period as a high exposure episode and interacted with the crisis. This identifies roughly 25% of my crisis as a high inflow crisis. Now, I can just plot the average cumulative growth after the different kinds of crises. There's no estimation involved, no trickery with controls that I could apply to convince you of a result where there's none. So in red, you see the average cumulative growth after all crises. And as expected, it's negative. It's maybe 2-3% on average, and then it recovers. But this recession is way more severe when the crisis has been preceded by consistent large, or 2-year at least in my case, exposure to gross foreign inflows. And in blue, I can repeat the exercise controlling for country fixed effects, like GDP growth and this kind of thing in a local projection exercise. And the result is really similar, that high exposure crises tend to have deeper recessions than other types of crises. I have this in a table as well. I will skip it because I think I have only 10 more minutes to go and want to talk about this one, which is the newest addition to the paper. I recently got the suggestion of trying to be a little bit more systematic about the capital flow episode I'm looking at. And there's this paper from Forbes and Warnock who say, well, we will identify 4 distinct episodes of flows, which are surges, stops, flight, and retrenchment. And they basically define it as an episode is defined as a surge if the current year is 1 standard deviation above the historic average. So in my case, I take the previous 3 years, take the mean of these, take the standard deviation of these, compute this on a rolling basis, and then for every observation, check if the current observation is above it, then it's a surge. It's a stop when it's 1 standard deviation below it for inflows, and for outflows, when it's 1 standard deviation above the historical mean, it's flight. When it's 1 standard deviation below, it's retrenchment. And I combine this with the level of capital flows. And what you can see here basically is in the first line, the story I've been telling you so far. So when you have high levels of capital flows, but capital keeps coming and coming and coming, you have lowered future GDP growth, you have a higher likelihood of financial crisis in the next year. But this is not necessarily a symmetric result for inflows, because, for example, if you have very low levels of capital flows and then you have increases, the result is that the future GDP growth is higher than the sample average. Now, this is a new result. I don't want to overemphasize it. I'm looking forward to your feedback on this. If it makes sense to sort of split the sample in these kind of episodes. And with that, I want to come to the second to last part of the paper, talking about the channels. So why is this happening? What does, or which channels link capital flows to outcomes? And the first one is the gold standard being the dominant monetary system in the interwar period. And previous research has really talked a lot about what the gold standard hindered countries from doing domestically. Because not being on the gold standard gives countries a certain margin of adjustment when a crisis strikes, and being on the gold standard takes this margin away. So in the first step, I check if not being on the gold standard, at least partially, is able to alleviate the negative relationship between capital flows and economic outcomes. And I interact not being on the gold standard with gross inflows. And I find that, in fact, not being on gold offers a partial insulation from these effects. And this result is quite similar if instead of the gold standard, I use a measure for capital account openness, which is quite related to what Mitchell and Wannschneider find, arguing that countries with closed capital accounts recovered faster from the Great Depression. Now, this is sort of on the domestic dimension of the gold standard. As my paper is more concerned with the international dimension, I check in a second step if being on gold increased the exposure to capital. So I run another local projection of capital flows on a gold standard indicator and find that countries on the gold standard experience higher level of capital inflows here for the balance, but this is driven by the result for credit, meaning gross capital inflows. And I take this as the gold standard really playing a dual role in the interwar period. For on the one hand, being restrictive domestically, so not allowing to respond to surging capital flows. And on the other hand, playing a role via increasing the exposure that a country has internationally, because it allows easier movements of capital via fixing, for example, the exchange rate, or signaling an international commitment to open capital account. Now, I think I'm going to skip over this as I only have 5 minutes. It's a slide on maturity mismatches, so asking what is foreign capital used for, and I look if foreign capital is how it is entering bank balance sheets, and I find that it finances short-term liabilities and long-term assets, meaning that a bank might face the problem of a sudden withdrawal of foreign capital. And when it's invested in long-term assets, this might create problems even for an otherwise solvent bank, because it's been financing these assets with more flighty foreign capital. Now, this is probably a little bit more intuitive. The balance of payments has an additional variable which I can exploit here, namely interest payments to foreigners. And I check in the first step if these interest payments increase in past foreign borrowing, the reasoning being, well, if you borrow from foreigners in the past, you would pay interest, and these interests will reduce your available income, and reductions in your available income in the long run will lead to consumption and lower growth. So I check if this is holding true in my sample. It does. And then I check if these interest payments to foreigners are related to future GDP growth. And indeed, it seems to be the case that higher interest payments to foreigners go hand in hand with lower growth in the future. Now, for the final part of the paper, the question is, why should a country borrow so much on international markets in the first place? So where does this capital come from? What's driving these inflows? And it's really difficult to distinguish these supply-demand forces in the balance of payments, simply because it's all reported together, as you have seen, either as a credit or a debit. And the argument I'm using here is that I take the United States as the biggest international creditor in this period, and the bilateral relationship of each country with the United States might be idiosyncratic to these two countries. But the aggregate decision of the United States to invest more abroad or to retract their abroad investment is something that is driven by the US itself and not by the individual partner. And so I construct a type of shift share argument where I interact the bilateral portfolio position in the past, so how exposed is a given country to the US, with the aggregate change of US foreign investments currently. And this is precisely what you see here. So USP is the United States portfolio investment position, in this case for 1926, simply because this is the first year for which I have comprehensive coverage. I have in the paper robustness checked with other dates, scaled by bank balance sheet size to sort of assess how important United States capital is for this country. And then this is interacted with the change in the total US investment position, excluding the country that is being instrumented to reduce endogeneity as much as possible. And a working instrument should really adjust sort of a potential downward bias in the baseline, because in the baseline, I cannot distinguish if, for example, a country has a huge demand for foreign capital and is able to satisfy this capital demand via accessing international markets. And why should that be bad? So why should it be sort of detrimental for future growth if countries funding reasonable investments with international capital? Or if it's sort of in this supply position where capital is being pushed into the country, irrespective of it being needed or not. So being able to take these forces apart could potentially correct this downward bias in the basement. And in this table, I report the baseline credit coefficient, in this case only for a single year, the interaction IV in a reduced form regression, and here the fully instrumented specification. And I find indeed that the instrumented coefficients are larger than the baseline. This is mostly also true for the reduced form, though not always. But generally, it seems to be the case that when it is possible to distinguish between foreign supply and demand, it is the foreign supply of capital that is driving the aggregate results and not the country idiosyncratic demand for foreign capital. Again, I test this for sort of all my baseline specifications. This holds true for financial crisis, for balance sheet expansions, and for robustness. I can, for example, decide not to fix the exposure measure to 1926, but make it dynamically adjusting, because it might be completely different between 1926 and 1929. But there's other problems with that, but it doesn't fundamentally change the results. And with that, almost perfectly in time, I come to the conclusion. So I construct this new data set. I'm quite convinced by this data. I'm happy to acknowledge that it has drawbacks, but I think there's still a lot to learn from it. I use it to show that capital inflows are the decisive link between international capital markets and macro outcomes, that gross foreign inflows are highly predictive of lowered future GDP growth. I find that gross inflows are associated with a higher likelihood of financial crisis in the future, that after these crises, the recessions tend to be more severe if countries were very exposed to foreign inflows before this crisis. And importantly, I find that results for net capital flows tend to be insignificant once gross flows are included in the model. Now, this is important to make this point. It's not about international markets generally having sort of a negative effect, but when the capital inflows are supply driven rather than a country funding its investment demands via, for example, international capital. And I also check if this is like a peculiarity of the interwar period by a very low-hanging fruit, downloading these balance of payment statistics, which are available from OECD countries for a later period, and run the same regressions for roughly the 1980s until pre-COVID, and find that the result in an external sample of countries look very, very similar. All right, with that, I'm done. Thank you very much. Looking forward to your questions.
Okay, thank you very much, Lukas. So on the Q&A, I have a couple of questions which I'm going to share with you. So there's one which I think is on a lot of people's mind, and that's in your robustness test toward the end you bring the US, but otherwise it's kind of a very anonymous story. And so Tai Kwang Ho would like to hear you a little bit more on the question of the German business cycle that's in the background. If I may risk a connection with with what is happening today, the IMF has all those questions about what is whether it's industrial policy that's driving the imbalance between China and the rest of the world, and they have concluded that not at all. But of course, we all know that there are questions of what is exogenous and what is endogenous in a model. So, I mean, this is opening a big can of worms, but I think that at some point you need to get there. The German business cycle, your turn.
My turn first would be that the beauty of the data set is it does not rely on any particular country on which we know a lot. So we know rather a lot about Germany being the primary creditor, the debt carousel of German reparations being financed via foreign borrowing, and then the international market drying up, forcing this sudden stop in Germany. But what I can say is that sort of what we know from the literature is very much what we see if we look at the country-specific data. So this is in no way in contrast to what we find. We find the United States and the United Kingdom supplying capital, France as well. Let me see. I think I have that in the appendix somewhere. There's lots of stuff going on. Yeah, here. Where we can basically see the debt carousel centered on Germany in action. So we see that cumulatively Germany keeps importing capital, which is mainly coming from the US, France, and the UK. And then you get the Great Depression, and then these positions in net terms revert when these countries start pulling back their capital, and these ones have to start paying their debt. And in the case of Germany, this sort of goes until 1933, and we all know what happened in 1933, that Germany stops under the Nazis the repayments, basically closing a capital account. So I would not say that my data is in any way arguing against these previous findings, but rather that sort of the beauty of having this super large sample is something that we didn't have before, that we can check on a more general level the relationship between capital flows in the economy. I can also, of course, show you what the country coefficient for Germany says, and it is one of the largest negative ones. And Germany being a large importer and then having one of the severest drops, being most reliant on foreign capital, and then very suddenly being cut off, might very much contribute to this coefficient here. With that, I would give it back to Mark.
Okay, if I may jump in with a couple of questions.
Sure.
So there's the notion, as you in fact mentioned, but the notion that of course capital flows were a big part of what was going on is something, right, that emerges already in the interwar. So they know about that, they write about that. Eventually, you quote, Keynes 1941. There's a reason why they even collect those data, right? Which is that they know that there's something going on. So could you elaborate a little bit on what the league is doing? What is your what is the also effect on both the data set and your results of some measurement issues? So, for instance, one thing that I personally have in mind, but one could think of many other points. The inside capital flows, there are various forms of capital flows that have different types of effect. So there's the long-term one and the short-term one. The obsession in the interwar is the short-term, is the hot money. There's a question of whether this is adequately measured, because for a number of countries, it was calculated as a residual. So if it's a residual of the rest of the calculation, you have a problem. So they complain about those things. And then when you move to the 30s, in fact, you get capital controls everywhere, which means in a number of cases that you have forced conversion of short-term debt into long-term debt, right? So can you elaborate a little bit on this data, this wonderful data, and what you understand was the way it was built and how this informs the descriptive statistics that you can then construct? Because I do think it's one of the key contributions you are attempting to make. So I think you need to tell us a bit more about that part of the story.
Yeah. So let me start with the back of your question. I cannot tell you how much of the short-term debt is officially transferred into long-term debt in the 1930s under capital controls. What I can tell you on the data, let me go back here, is that these positions, of course, should, strictly speaking, always be completely identical. They are not, but I think it's also sort of a mistaken expectation that they should be on the dot, the same for accounting issues. What is true is, for example, these kind of items, that there simply is no knowledge. It seems very unlikely that the US had zero short-term capital exports in 1932. So there is this this issue of the data simply not knowing exactly what a short-term capital flow constitutes. The long-term capital flows are a little bit less problematic, and you're right, sometimes they're filled by residuals. And they precisely use this kind of accounting framework saying, well, the balances should be perfectly identical. We trust our own computation of the current account balance more, so we invert it and compute the one item that perfectly equates the two. So I completely acknowledge this limitation. And in fact, the new version of the paper elaborates on that quite a bit, explaining in detail how I construct the data set. So give me like a quick preview of this. What I do here is I check for observations where the current and the capital flow balance are not equal, meaning they have not been made equal by construction. When they are equal on the dot, it's very likely that there has been some kind of balancing item being introduced, simply because it's so unlikely that without that, they appear perfectly on point at the end of the period. And what you can see here is that when they have not been made equal by construction, the relationship between as it should be is negative. It's quite high, but it's not perfect. So, and then sort of the second point of my argument would be that we can figure out which part of flows is being systematically over or underreported here. And the dashed line would be if they are always perfectly identical. And if this line here deviates quite a bit from the dashed line, that would mean at least one part of credit or debit is systematically not collected. And for example, because the capital account balance is defined as the difference between credit and debit, constantly missing credit items would mean that for any level of the current account, the capital account balance would be smaller. So it would be less steep in this example. And I would argue that yes, there might be something here, but it's not super systematic. So there's not systematically one type of account that is being underreported in the data. And in a second step, I can check, well, is this difference between the two balances really relevant? So what I do is I check the absolute deviation between the two balances and plot it as a fraction of total gross flows against gross flows. And what we can see is that on the one hand, okay, yes, there are observations where this deviation is relatively large in terms of the total recorded capital flows, but for the vast majority of data, the deviation is between 0 and 30%, which is still substantial, but it's not gigantic, and it's decreasing in gross capital flows, either meaning that it grows less important when gross flows are large, or that we have better statistics for larger countries, which just report more and larger flows, making sort of the deviations between the balances less important. I have these statistics now in the paper. I think it's out of around 360 final observations, around 80 include such a balancing item perfectly equating the two. The other ones are these ones where the balances do not line up exactly. And yeah, I cannot really say more to that. There's this limitation. But I think my analysis does not really rely on the precise knowledge of what is long-term and short-term, because I only use it in some exercises, and the baseline results go through without the distinction between long and short-term. It would be super interesting to delve deeper into that. But as you rightly said, it's not clear if we can completely trust this data. And yeah, I think my analysis does not rely on it. It would be nice to know more about that. And yeah, I will. In the next version, I will try to address this more comprehensively.
Okay, thank you. Bob Macaulay would like to get to the, I guess it's the genealogy of ideas on gross versus net. So I think the best way to go, Bob, if you're fine with that, we've unmuted you so you can speak and ask your question and elaborate a little bit on the point you're making.
Sure. Thanks, Mark. Can you hear me?
Yep, I can.
Great. So the association is drawn on an early slide between Kindleberger 1978, I take to be manias, panics, and crashes, and the view that it's sort of net flows that matter. And given Kindleberger's clear debt to Minsky, which then connects to kind of gross domestic debt growth as the source of problems, seems to me that the more natural reading of Kindleberger is that he's talking about gross flows as being the source of the problem and contagion and so on.
I'm not sure if that's, yeah, maybe it's the more natural reading. I didn't read it like this. I think maybe the terminology was not as we would use it today. What I sort of would read into him is more that he knows that these capital movements are quite large, and he's thinking about what they do domestically. So he's talking about that they fund domestic credit, and this sort of leads to an amplification of the ongoing domestic financial cycle, which is sort of country specific, and then if the international financial cycle comes in, this leads to be amplified. I think this is something that I would very much support here. So it's an amplification mechanism of boom bust episodes, which we observe for these countries. So, which is why sort of in the newest edition, I want to look more on these, which is sort of the amplification mechanism in both directions, right? So if you have, for example, a very low level, and then you have a surge in capital flows, you might have a stronger boom. But if you have a high level of flows and then you have a stop, you also have a stronger bust. So this is very much in support of that. I cannot really say too much about the reading. If he was explicitly saying, well, this is due to gross flows, I would have understood it more as thinking about the balance of payments, which I think is something that seems to be relatively frequent in this early edition. So this kind of amplification of recessions was also something that Keynes already thought about. And he explicitly said that this was for deficit countries, so deficit in the sense of being a net debtor on international market. But yeah, I wouldn't say something I cannot take back on what exactly he said on gross capital flows.
Just one more word then. To me, read Kindleberger in line with the sort of Borio argument that especially the interbank flows come into a country where credit is already rapidly growing and allows credit to grow faster than, say, deposit growth. And so it's like that's the Borio argument. In Shin, it's sort of the managed liabilities that is enabling the domestic banking system to outrun its sort of natural deposit growth in the extension of credit. But I'll stop there.
Yep. No, this is something I can get completely behind. This is something I believe that's happening here, which is partially here. So you have this this increase in deposits. So I was super quick in the presentation on the slide, but what this tells us is that one additional dollar of gross inflows is linked on average to a bank balance sheet expansion of 30 cents. And if we break it down on the liability side of the bank, 16 of this is via deposits, which has been argued has been sort of the predominant form of international investments, short-term in the interwar period. And this has been used by banks to finance loans on the asset side and to purchase bonds, both of which tend to be longer term than these deposits. It's something that is not found for the balance, which I think makes sense because this mechanism works just well in countries that are in a surplus or in a deficit, because for the bank itself, it doesn't really matter what another bank is doing. One bank might be financing their balance sheet expansion from abroad, and another might do it somewhere else. So the net position of the country is unclear, but from a bank perspective, the gross flow is what matters. And I think this would be perfectly in line with what you're saying. The bank might finance domestic operations increasingly with foreign capital, which allows it to expand beyond its purely domestic abilities.
Okay, thank you very much. So I'm asked to close the first part of this seminar. We'll have the 15 minutes extension starting immediately after that. And I'm asked to make an announcement when people are, everybody is still around. The next seminar in 2 weeks, that's Jamilov, Müller, Koenig, Saidi, 2 centuries of systemic bank runs. Yeah, so moving to the prolongation, there's Anja wanted to take you to task with the robustness, endogeneity part of your paper. And in particular, when you work up the interaction term by using the US. Of course, the US is a large trading country, but why not use, that's Anne's question, why not use a country's largest trading partner as opposed to the US?
Interesting question.
More data.
Yeah, the easy answer is yeah, the US has this kind of data. So there are publications from the 1930s stating these are the United States portfolio investment positions in other countries. I have honestly not thought about looking at the largest trading partner. Maybe I've been too restricted in the way I thought about this. I was thinking about capital flows and not so much about trade flows. So strictly, I think we should think about the country's largest investment partner. It doesn't necessarily need to be the same as the trading partner. I think there's ongoing work on looking at bilateral trade relationships. So I think there's O'Rourke Van Schneider collecting this data at the moment. I think it's possible to get it. I agree on the assessment that my approach might be too US centric. So the United States had just this very moment sort of overtaken the UK as the main international financier. And this is something that appears in these publications. So they say now the United States is having this investment position with this and that and that country. And the reason they are collecting it is because they're so surprised by how fast it has grown and how it has outpaced the UK. So what I do sort of as a robustness check to be less centric on the US is I construct a principal component of the capital exports of all countries, excluding the instrumented one. There's this, I can maybe even share my screen again, if I have it in the appendix somewhere. I think I might have dropped it because so far no one has asked this question, but it's a good one. So sorry, what I do is I construct this principal component over the capital exports of all countries to use it as a measure of sort of the global capital supply in a given year. And the argument there would be similar to the instrument I have here. So what all other countries except country I are exporting is very unlikely to be driven by this one omitted country. And because taking the principal component, it makes it sort of a comparable variable for all other countries, which is always like slightly different due to the different omitted country I, and then use it similarly in an IV exercise. It's also a bit more flexible because it's easier to sum the principal component over several years with the shift share. It's a bit less clear if that's a good idea. And the results are very, very similar. I agree it would be an interesting point to figure out if this would work with trading partners, though I'm not entirely sure if trading partners is what we would be looking for, but sort of the largest partner in terms of financial transactions. A trade might be a good, though not necessarily perfect proxy for that.
Okay. I guess we are running out. Oh no, Rui is raising his hand. Rui, go ahead.
Yeah. Sorry, Lucas. I'm going to ask you the same question twice, right?
Okay.
So I know you identified a fantastic data source that had been overlooked, but it's measured in nominal flows, right? So there's no attempt to address it for valuation changes, right? We know that valuation changes are super important in gross, as in net capital flows, as effective net wealth transfers. So what are you thinking about that?
You're right.
If I may, Rui, it hasn't been overlooked, right?
Yeah, it's not.
Well,
okay.
Not in this sense. Yeah, sure. Stand correct.
People know it's there, but I think they have seen that sort of on first glance, it really has a lot of shortcomings. And my point is not really to say, well, those shortcomings are not true, but to say, okay, I collect all of it anyway, and because it, in the end, has such a large sample, it allows me to run like log projections, which I think have not been done using this data. So, I mean, Rui is still completely right. It's nominal data. No revaluations are included. I am collecting at the moment the international indebtedness for these countries. That's a little bit more tricky, but a change in the international indebtedness would be the capital flow I have in the data plus some level of revaluation and repayment. I'm not sure that the two would perfectly line up, and if I would trust the residual of the two to be this kind of revaluation. But I think it would be a nice robustness exercise to use sort of changes in the international investment position rather than the sum of flows in a robustness exercise to say, well, if I include, or at least tacitly include these valuations, I find something similar. So large increases in indebtedness via, for example, a depreciation in currency should, in the line of argument that I'm making here, have a similar effect. And I totally agree on that. The data exists. It's less comprehensive. It comes from the same source though, and I'm collecting it at the moment. I think the best I can do right now for valuation changes in terms of currency is that I take all of this data that I have and convert it into US dollar at the 1933 gold parity. So these publications, they're structured by chapter, by country, and each country has its own table in domestic currency. But in the very beginning of the book, there's the main aggregates for each country given in US dollars. And from that, I can infer exchange rates to the US dollar that the league itself is using. And what I do is I compute this exchange rate, transfer everything into US dollars. And interestingly, the United States depreciates against itself after 1933 because they keep the exchange rate fixed to before abandoning the gold standard. And I think this partially addresses the question because at least there's no revaluation regarding the currency going on because it's the same currency for all countries in my sample. The revaluation of foreign debt itself, tough to assess, but I'd say not impossible necessarily.
No, fair enough. Fair enough. We just get greedy and we want more data, but there's Nathan Sussman with a maybe non-greedy question. Go ahead, Nathan.
I don't know if it's non-greedy, but it's more of a so looking at your appendix figure 3.5, that I find really interesting is when you look at the distribution of the coefficients over the sample.
Yeah.
And so obviously, I mean, you mentioned that 3/4 or whatever are negative, but if you look at significance, so that reduces to quite a small subset. And there's some really large outliers. Some of them, I think, so I think it would benefit the paper to discuss maybe some of these. I think, for instance, Canada seems like a very interesting outlier because usually the Bordeaux view is of the Canadian financial system being robust and whatever, and relative to the United States at least. And but in your regression, I think that you see the coefficient is one of the most significant large ones. And so adding a little bit of I mean, I'm not questioning the econometrics or anything, but just adding a little bit more content in terms of some histories of these particular cases that seem to drive a lot of the results could be quite interesting. So you have the usual suspect, the Germany, Poland, and so these are kind of the usual suspects. But Canada seems like an interesting case here that. Or anyway, so just doing a little bit more with this figure, because you see a lot of heterogeneity there. It's quite large.
Yeah. So I mean, the chief excuse from my side would be there's lots of noise in the data. That's just true. Like the data as the way it is collected is partially built on sort of a guesstimate, and these change over time. The league is changing them. The countries change what they're reporting to the league, and these balancing items, they naturally produce this sort of noise by definition because it's one item that's either put to credit or to debit, and that's just producing noise. For Canada, I cannot really specifically address that. I know that the argument is usually that it has been relatively stable. I could look into Canada in greater detail. this is just the baseline regression. I could look sort of as the interaction in terms of Canada and crisis, depending on the chronology. I think depending on chronology, there might not even be a recorded crisis in Canada. But yeah, that's about as much as I can say to that. I was looking at this graph and thought, okay, great, Germany's there, US is there. It's a lot of negative countries. People will like it, and of course, this kind of graph, when you have so many negative countries, will produce significance using country fixed effect in a pooled regression. But if you take out the country fixed effect and run it sort of as a time series, the noise just blows up. And yeah, I think you're right. The story could be told for any individual country, but again, sort of, I think the nice thing is that you don't have to, which doesn't mean that I should not address sort of the countries where the result go a little bit against conventional wisdom, where everything is sort of in line with what people say anyway. I can maybe doesn't need as much explanation as the case that you mentioned where it goes a little bit against.
Yeah. Okay, so on this, and you don't necessarily have to respond, but if I can sort of push a little bit further on Nathan's point. So he mentions Canada, but when you look at the guys who are on the left of that chart, you get Central Europe and British Empire, right? So you want to be doing something of that, right? So, and also since we're running out of time, but I really do think that in terms of what you can do with this database, I feel that there's a tension in your paper where you are interested in kind of theories out there. And of course, the database lends itself naturally to, come back to the topic. But I think that in furthering on Nathan's nudge, there is a sense in which if you use your database in kind of a almost more agnostic way, and sort of just as a fact-finding thing, emphasizing the limitations that this data has. Again, league economists hated that database, so you need to bear that in mind somehow. So that was one reason why people have known about it, and I think have been a little bit reluctant. Now someone had to do it. Okay, it fell upon you, but somehow sort of I suggest you go with the flow of the data set that you have and sort of come up with a lot of those descriptive regularities or pattern or bizarre features, which actually invites us to think, I think, in even more interesting way than just testing or revisiting ideas that are kind of are in everybody's mind and have a smaller learning power. At least that is my takeaway. Since I was asked to moderate, that's the kind of enthusiasm that I would express as conclusion. We still have 1 minute, right, Nathan and Henri? So if you want to say something, if you see something, say something.
No, we're fine. We don't need to go to the last second. So okay. Thanks a lot, Lukas, again for posting your paper.
All right. So thank you very much, Lukas, and to the organizer.
Yes. And thank you, Mark.
Yeah.
Thank you, Mark. Thanks, everyone.
Thank you very much for having me. See you next time.
Bye-bye.
Take care. Bye.